Today, one rate up. How many more to go? Hello again, it's Martin North from Digital Finance Analytics. Web Notice posts covering finance and problem news with a distinctively Australian flavour. Today, I'm joined by Steve from Canstar. Hi, Steve.
G'day, Martin.
Pretty busy your end and my end with all of these movements with regard to interest rates, but I thought we should have a conversation about the RBA's announcement on Tuesday, what it means, but more importantly, what's ahead.
Yeah, look, absolutely. It's been absolutely hectic, but it's a lot of fun. I was going to the office on RBA Tuesdays and wish everyone a happy RBA day. And so I guess I'm a finance nerd. I get excited by these things. But yeah, it's been absolutely hectic. This is the first increase we've seen in 11 and a half years. So so it's big news, and people have become excited by it.
Yeah, and it's interesting that the newspapers and TV have been all over it. And of course, we've got the election, and we might talk later about some of the issues there. But also, Phil Lowe actually gave a press conference, which he doesn't normally do. All right. And that, I think, also marks and underscores the significance of the move, right? This is basically interest rates are going up. But of course, last November, he was suggesting no change until 2024. So the world has changed, and it's changed quite quickly.
It has, but I don't think too many people really believe that that projection was correct. I think most people were saying sometime around this period for quite a while. I've been saying for a long time, last quarter of this calendar year. But I think when 5.1% of inflation comes around, you look at it and say, no, you can't wait any longer. You've got to do it now, because we're going to end up in an awful hole if we move too late.
Yeah, and I guess the big question is, and we won't know until later, whether in fact lifting interest rates when inflation is largely being driven by supply chain problems is going to help.
Yeah, look, this is a really fine tightrope that the Reserve Bank's walking, and I guess the government is too, because what effectively the Reserve Bank is saying, look, is we're putting up interest rates to get inflation under control, but we know that most of the inflation, or at least this huge blip in inflation, has been caused through supply chain problems overseas that have really originated in China and Europe through the conflict there. So it won't actually have an immediate effect on those prices. At the same time, though, they're very conscious of the fact that wages haven't gone up. So you bump up interest rates and people are up for a higher mortgage cost, but their wages have gone up. So it's going to create a lot of stress. Cost of living pressures are already on, and it's going to create a lot of stress for people, and a lot of people will struggle with their repayments. What the Reserve Bank is hoping is that high, low unemployment, so unemployment below 4%, is going to actually start feeding through quickly into wages, so that people can cover that extra mortgage repayment. It's a real tightrope, though, because it says bump up interest rates to get inflation under control, but at the same time hope that wages will go up, wages will inflate. Now, that's a real tough call, and that requires a real Goldilocks reaction to this move if it's going to work.
And of course, the point there is that if you start putting wages up, that has upward pressure on costs of businesses, so, which is inflationary. So actually, almost say, well, you're trying to pull in two directions at the same time. Yeah,
it's quite. I mean, it's the logic is tricky to follow. And I guess I think they've been between a real rock and a hard place, frankly, and I'm not sure what else they could have done. But he wanted to, and this is why he kept talking a longer time frame. Philip Lowe wanted to see wage inflation before he put interest rates up, and to hope that you'll get inflation under control, but you'll still see wages go up. And you'll put a dampener on the economy, but wages will still go up and people will be able to afford their home loans. all of those things, gee, to get that in alignment, I'm not sure that that's realistic.
Well, it is very interesting. So the Bank of England, of course, put their cash rate up again overnight. And Andrew Bailey said a couple of quite interesting things. One of them, that inflation in the UK could be up to 10% before it comes back later. But earlier on, he was pleading with people not to ask for wage rises because that would actually drive inflation higher. So again, you can see how these central banks are trapped. And, you've got to ask the question, well, did they take rates too low? Did they do too much quantitative easing? Is that one of the reasons why we've now got asset price inflation as well as, the other stuff we're looking at? We are in a very complex environment. And the interesting question is, do central banks, do they really have the toolkit to deal with this?
Yeah, look, I don't think they do at the moment, to be quite honest. You and I can both remember stagflation in the mid-'70s, and that was a terrible scenario to have, where growth, well, for people who weren't around, growth was low, unemployment was high, inflation was high. And of course, all of the traditional measures, whether they be government spending measures or monetary policy through reserve banks, all of it said, well, heck, we can't actually address both of those problems at the same time. Now, this isn't quite the same as that, but it's a similar conundrum that the Reserve Bank finds themselves in. And I empathise with them, but I think, well, gee, in retrospect, probably we did put too much stimulus in monetary policy, but at the time, I see why they did it. So it's easy to say now, but right around the world, central banks did the same thing.
And Adrian Orr from New Zealand Reserve Bank, in a recent discussion with the Parliament over there, said, look, no regrets. We could only deal with what we could deal with at the time we could deal with it, right? So there's no point in looking back and saying, did we do it right? Did we do it? We could only do it based on the information we had at the time.
Yeah, that's right. And we thought when COVID came around that we were in for the mother of all recessions. We thought that property prices would fall off a cliff. Some of the banks were talking about 30% decreases in property prices. Instead, they boomed. Now, everyone got it wrong, and it meant that there was a huge amount of stimulus went into the economy through government spending and through the Reserve Bank interest rates. But I don't know that at the time anyone could have anticipated the scenario that played out.
No, and that's sort of, when there are so many moving parts, and of course now we've got moving parts, including the war in Ukraine, the oil situation, the price of wheat or the supply of wheat. I mean, there are so many moving parts. Maybe nobody will be, able to call it all right. So you muddle along and do the best you can. I think is probably the order of the day from central banks. But let me talk.
And you didn't even mention Chinese growth and what's happening over there and the lockdowns in China. And for Australia, that's massive. And, it's playing out through the share price of our big miners.
Yeah, absolutely. So a time of uncertainty. But there is also a time of uncertainty for individuals who have mortgages. And let's just explore that a little bit, right? Because I guess the thing to underscore is that this first move up probably won't be the last move up.
No, it won't. And, the 0.25% increase that we saw on Tuesday adds about $68 to existing borrowers' mortgages. Now, that's based on the average $500,000 mortgage. Double that if you're on $1 million mortgage, and plenty of people are. Now, that's kind of, for a lot of households, that's affordable. Plenty of borrowers are already ahead with their repayments, have money in redraw and stuff like that. So it's affordable for a lot of people, but there are still plenty of people who are right on the edge, just covering the grocery bills and putting petrol in the car already. And that's another $68 they've got to find from somewhere. And if you've borrowed in more recent times, over the last 12 or 18 months, you've paid a very high price and you've got a big fat mortgage and you haven't had time to get ahead with your repayments or to build up that much equity in the property. And I think that group is particularly vulnerable even now with just the 0.25% increase. But the Reserve Bank governor says that a 2.5% cash rate is not unreasonable. in 12 months' time. I've looked at the history of cash rate increases over the last 20 years, and virtually every time it goes up by 1.5 to 2% in the ensuing 18 months or 2 years after the first increase off a bottom. So, you've got to be planning for a 2% increase. So you're not talking anymore about $68 a month. You're talking about $575 a month increase on your monthly repayment on a $500,000 loan. It's a big number to find in most household budgets.
Absolutely. And, in round number terms, from my calculations, a 2% rise is equivalent to a 30% increase in monthly repayments, right? And that's because, of course, the interest rates are so low, and so we're actually not paying very much by way of interest. So even a small incremental rise lifts the amount you have to pay in interest substantially.
Yeah, it does. And people kind of, it's hard to fathom. We shouldn't even bother trying to go into the maths. But your repayment covers both a principal reduction and the interest cost. And when rates go as low as they have been, it doesn't take much to bump up that interest cost, much in the way of an increase in interest rate to bump up the interest costs. And so really it's this is keeping your repayment on schedule to be repaid over 30 years, but the interest bill has gone up dramatically.
And what you do is you spread the costs over the life of the loan, but in the early years you are paying way more interest. Because the capital amount that you're borrowing is actually bigger than it is as you start making repayments later. So there's a bit of a crossover later in the life of the loan, and you start then paying down more capital. But in the early years,
actually, people can see this. This is it's a good point to make, because I don't think too many people quite understand it. Now, you don't have to understand the math because it's built into calculators online. Now, Canstar's calculator shows just how that changes over time. You see a nice curve that falls down, and you'll see that, yes, your repayment hasn't. If interest rates don't move, your repayment doesn't change, but you'll just see this gradual decline in the principal. So much more of the repayment, the monthly repayment, is going to reduce principal. So you get onto that downward exponential curve that you keeps getting steeper downward, and you knock off the end of the loan. The last 5 years of the loan, you knock it off dramatically.
Absolutely, but in the early years, the reverse is true. You're ultimately
that's right.
You are paying maximum interest on the maximum amount that you've borrowed. So anybody who's borrowed in the last couple of years, as you said earlier on, have really not started to make any inroads in terms of the value they've got. Now, of course, the other context here is people are now suggesting that maybe property prices will come off a bit too, and we're already seeing some early signs. So some of the more recent reports are suggesting that prices are beginning to ease. So again, we've got the situation where we've got a number of new buyers who went in with very large mortgages, sometimes, by the way, encouraged by the government through its policies, first home buyer grants, etc., big loan, top of the market, and now we've got the double whammy of interest rates effectively going up and property prices beginning to come down. Now that pincer movement is horribly familiar for us who've been around over a number of cycles, but for many people who've never seen that, this is a very uncomfortable time.
If you have trouble with your repayments on a home loan, but you've got lots of equity in the property, you've had the property for quite a while and you own 30-40% of the property, the home loan repayments is your problem and not the bank's. But if you've only been in the property for a short time and have very skinny equity, you've still only got 5%, 7, 8, 10%, whatever it is, of the property, and you can't make your repayments, it becomes the bank's problem as well as your problem. Now, when it's the bank's problem as well as your problem, the bank's going to have a little bit less patience. So you've got to be, so you're in a very difficult spot if you fall behind with your repayments. I guess the only good advice you can give people at this stage is get into the lowest price loan you can possibly find so that any increases are coming off a lower base. And there are still plenty of loans that are down around 2%. There won't be as many in coming weeks, but there are still plenty at the moment. get into one of those and make sure you keep your repayments going. Now, if you make sure you keep your repayments going, the bank isn't going to get too worried about the fall in your equity. They'll be nervous about it, and they'll be nervous about it in a macro sense, because they'll be worried about their situation, their position if we do hit hard times. And the ratings agencies also will be looking at them and saying, should we be downgrading them, which makes their funding costs higher. But in an individual sense, they're not going to sell people up if they're making their repayments just because the market has corrected. That would be a disaster for the banks, a disaster for the individuals, and a disaster for society and the whole system. So they won't do that. So keep your repayments going and don't get too hung up about the equity fall. If prices do fall, they're likely to, but if they fall, it normally will correct. You know, you will get to a point where there'll be a correction of 5 or even 10% prices, even worse in some parts of Australia. But over the long term, they have always corrected and got back onto a nice even keel and started going up again. So don't get too hung up about it, but keep your repayments going.
Yeah, and it's just worth reflecting on that cycle. So if you look at the global financial crisis in the UK and in the US, there were households who were in negative equity for 5 to 8 years before prices then started to turn and go up again. During that time, of course, they were not able to move. They couldn't necessarily get the cheapest loans, but nevertheless, they were still in their properties.
Yeah, that's right. They held on to the property, which is the important thing. But you're absolutely right. I mean, we always say to people, look, shop around, make sure you don't pay too much for your loan, make sure that you're conscious of the great deals that are available and get into one of them. But if you are in that sort of awkward situation, you can't do that. So you just have to say, well, I've got to sit tight with this lender because no one else is going to lend this loan, or give me this loan fresh. So you're stuck with that one lender. So you will get trapped into paying a higher interest rate potentially than you need to, but sit it out and keep the repayments going. That's all you can do.
Let's just go over that again, because this is really, really important, right? There are things that people can do now to move into the cheapest possible loan that they can get. And we know from our research and your research that many people are sitting on loans at much higher interest rates than they need to pay. Now, if this isn't the imperative that you need to go find that cheap loan, well, this is it, right?
This is absolutely it. The average loan is 2.98%. Now, that will be higher now. It's going up, of course, because of the Reserve Bank move. But you can add 25 basis points, so it'll be just under 3.15%. There are still loans available, plenty of them, for 1% below that. And frankly, that saves you a lot of money. Now, you won't stay at 1% below, you won't stay at 2.152%. For that long going forward, because the interest rate increases are going through. But it's a lot better to be getting onto a low repayment, keep your a low compulsory repayment, keep your repayments up so that you build up a bit of a buffer, and set a base that's low so that you're bringing through those 0.25% increases from the Reserve Bank from a low base, not from this average base. And I talk about average, but then there are plenty of people on package loans with banks they've been on the same loan for years and they're paying more like 3.5%, not 3%. So make sure you do something about it. Get onto a low rate loan, set your base low so that the increases that the Reserve Bank brings in are from that low base.
And a general rule of thumb is that maybe the big four aren't the best rates.
Yeah, they have some very sharp rates, but they also have, for people who haven't renegotiated and have been in their loan for a long time, that's where you'll be on that 3.5, 3.4, 3.6% rate. And that's just gone up by 0.25. So add 0.25 to that. So I'm talking about 3.75 basically is the rate you'll be on if you've had your loan for that long. But they do offer sort of loans at 2.35 or something as well, and 2.4. or 5. So they do have cheaper price loans. So even at your own bank, you can get a better deal without switching banks. You've just got to go to the bank and convince them that you know what you're talking about. And you do that by doing some homework and saying, look, I know these rates are available and I can get them from the guy down the road if you won't do it for me. So try that. But if you need to go to another bank to get the good deal, well, that's the time to do it.
Absolutely. Shop around for, get the information so that you can actually prove your point. And again, I find that people are actually able to negotiate a better rate from their existing lender, which of course is very convenient to do, but you have to pluck up the courage to do it. And I still have this vision of the bank manager sitting in his high chair looking down on you as a little customer. Don't think of it like that, right? Remember that they are there to serve you, they are there to help you, and so you have every right to ask for a better loan rate.
Yeah, you do. I mean, the days of you're going to see the bank manager and you put the magazines down the back of your pants for the beating, they're gone. Actually, they are gone. It's a good thing too. But I think a lot of people still remember those days and think, oh, gee, I hate doing this. It's not a very comfortable feeling at all. But it's a lot easier now than it ever used to be. And you'll find that they want to retain your business. And the other bank down the road, if you can't get the deal from your guy, he wants your business. Now, that's all on the proviso that at this stage you've been able to keep your repayments up. And it always comes back to that, because if you can prove up that you've been making repayments for the last 2 years, 10 years, whatever it is, without any drama, then you're a good lend as far as the banks are concerned.
Absolutely. Well, let's just briefly then explore the hardship issue, because banks do have an obligation to help in cases of hardship. In other words, when you can't make those repayments or you're having difficulty making those repayments. But again, what I find in my surveys is that those people who are in that experience, who are making horrible decisions about what they can and what they can't afford, and maybe not really being able to afford the mortgage repayments, they should also talk to their banks.
Yeah, look, there is no point in thinking it will go away if you stay quiet about it, because it won't. The bank sees within days that you haven't made your repayment. Now, they don't get excited within days, but within a month, they'll be contacting you and saying, look, you haven't made your repayment, what's going on? So keeping quiet about the financial difficulty and thinking you'll blunder through it and the bank won't notice just doesn't work. When you hit that sort of problem, you've got to go and talk to them and say, look, I need some help. I need to either pause my repayments or cut them back for a period of time. And if the bank can see light at the end of the tunnel, they'll help you out. And I'll help you out anyway, right, in the first instance. But I mean, it can't go on forever. It's really the problem. But they'll help you out. They have obligations to do it, and they want to do it. Selling up people is a very bad look. So banks don't want to do that. So go and talk to them and find out exactly what is available. And there is relief in terms of repayments. Usually is the only real lever that the bank can pull on it. And but they'll like to be able and prepared to do that.
Yeah, and just, I guess, a little word of caution, because the strategies sometimes are to extend the life of the loan. So you pay for longer, but you pay slightly less for longer. But there is an interest cost when you do that. The other one is to draw down equity, if you've got equity in the property, to be able to actually help pay some of the other bills. But drawing down equity in a falling housing market is also quite risky too. So the point there is that some of these various arrangements that are actually mooted as a way out may only be short-term fixes.
Yeah, they are, and be careful about thinking interest only is a good answer too, because it's the same sort of problem. You're right. I mean, there's no free lunch with this. It's not like the bank is saying we're forgiving part of the loan. They're not doing that at all. They're adding the repayments you're not making mean that the loan is escalating. The amount you're owing is escalating because you're not even covering interest in all likelihood. So So you'll owe the bank more, your equity in the property will be less. It means that down the track you'll not be able to clear as much when you sell the property, and it could mean that you end up in a negative equity or a very thin equity position, and the bank's going to say, look, we've got to do something about this. We can't let this continue. You've got to sell this house. So yeah, there's no free lunch when it comes to hitting this problem. But you still want to talk to them and find out what can be done so that you buy some time.
Absolutely. And again, in my surveys, I'm seeing that the banks are a little bit more aggressive now in giving people a bit of a poke and saying, look, your finances have permanently changed. We don't want to move into foreclosure with you, but you really should put the property on the market, etc. We'll give you time to do that so that you can sell and get out and repay us. That we're seeing that more and more. And I suspect over the next couple of years, there'll be more people who will be given the big prod and say, get on with it, sell it, or we'll foreclose.
And eventually the bank has to do that if people are in a position where they just don't have the income to make repayments and to reduce the loan. So eventually they will have that conversation with people, and it's better that they have it kind of sooner than later. So, it's a fine line between, where people's interests are best met. But if you leave it too late, that decision, people have lost, all of their equity. And that's not a good feel. You want people to walk away with enough to eventually start again, not go down to ground zero before they get out.
Absolutely. And I guess just to finish this conversation, it's worth saying there are people who've got big buffers. There are people who will be able to make those mortgage repayments no problem at all. But the marginal buyer, the one who's come in recently, the one who's got lots of other financial pressures, are the ones that are going to be vulnerable. And I guess the risk also is that they reach for things like credit cards or buy now, pay later, or, other fix-it-quick solutions. None of those really are very sensible.
No, they're not. One of the big banks, I think it was Combank, but anyway, it doesn't matter. About a year ago, came out with a stat that talked about how many people are ahead with their loans and have large balances in offset accounts or large balances available on redraw. And it's a very strong number. People have taken the advice to get ahead with their loans and have that money available for just what's happening now and in the coming couple of years. But you're right, it is the recent buyers that don't have it. So that's the problem for them. Reaching for a credit card might be something you'll do as a last resort, but it's very expensive debt and it gets you in deeper again. And I'd always suggest to people that unless they can see their way clear of the problem, it's a very temporary problem, unless they can see their way clear of it within a few months, that's not a great move. You're better off seeing the bank first about getting relief on the repayments for a period before you go to that sort of last resort, because that debt on your credit card will put you under even more pressure.
Absolutely. So complex and difficult times, expect interest rates to go higher ahead, but plan ahead and use the tools that are available. Canstar's tools are brilliant. See what you can find by way of alternatives, and also do a bit of planning. Don't just wait to see what happens. Plan now for what's going to happen ahead.
Yeah, absolutely. If there's no point in waiting, because you will be up for a much bigger repayment, and whether it is up by 2% or whether it's up by 1.5%, doesn't matter. It's going to be a much bigger number. Plan for 2% more, and plan for it now, and start working, get it done, get the lower priced loan, get your repayments up, look at your budget and work out how else you can fix your budget. And if you've got credit card debt, knock that off so that you've got that out of the way. And if you do need a temporary buffer on something, well, at least you might have that balance for a couple of payments. But do it now, don't wait, because it is happening. It's not something that will go away.
Yeah, great advice, Steve. Well, thanks, as always, for your insights. Really appreciate it. And I'm sure we'll pick up the conversation as rates move ahead.
I think we will, Martin. Yeah.
See you soon. Thanks. Bye.
Okay. Cheers, mate.